So some current news is inflation came out higher than expected. What kind of investments do well during a high inflation period?
Okay, good. Well, that's obviously a topical question. This week, as most of you probably know, they reported the CPI, the Consumer Price Index, which was up 4.2% versus the same time last year, and which is a really big number. That's a huge inflationary number for the U.S. anyway. Now, the year over year comparison is a little bit skewed because last year, basically in April, things were down. And matter of fact, prices were struggling to stay at the same level. And so, but if you look at month over month, so March versus April, actually had, depending on what portion of the you look at, but it's up about 0.9%. And so that's a big deal too. That's a big jump from a 1 month period. And so we're seeing, all of these different issues that are coming in, creating these problems. And most of it is kind of concentrated in certain areas like used cars and travel and hotels and those types of things. And it's a very basic concept. You got people that are willing to come out of the shelter in place at a faster rate than businesses have been able to keep up, and you have employees that are actually reluctant to come back into the workplace for a variety of different reasons. So, how do you invest in that? Is basically the question. So let me share my screen and I can kind of show you, our current portfolio and what I think we should be looking at. And so this is our traditional model. We have two different models. We have a traditional investment model, and then we have an environmental, social, and governance model. I'll use this one just to kind of highlight. This is the stock portion. I'll show you the bond portion in a minute. And I have kind of an equal weight concept here. 15 different pieces altogether is what I've got in the portfolio at the moment. And so basically, I always start with, the total stock market index. So this is Vanguard's version of basically buying the entire U.S. market. And so there's roughly 3,600 stocks in here. And then we just kind of add to that. So here's the S&P 500, right? Already in this particular piece of the portfolio, but the S&P 500 is very popular. Neither of which is a particularly, spectacular arena for higher inflation, but you don't know what's going to happen. And so I always like to have some of the broad market pieces in there. Um, and then this company Invesco has three pieces here. They're called pure value: S&P 500, S&P mid cap 400, and S&P small cap 600. And what they're doing is they're taking the S&P indexes. So this S&P 500 is the same index, but they're just carving out the value stocks, the heavy value stocks. And what we've seen is that in times of higher inflation, value stocks tend to kind of really do better. And they're usually their higher inflation's coming because we have an economy that's growing quite quickly, and these value stocks are more sensitive to economic growth, which means that they hopefully will make more during that period of time. So I really like these. So far, I've been pretty pleased with those. Then I have two more value factors. And so what they're doing here is they're applying screens to the overall market to find what they feel is the best value. One is iShares, which is managed by BlackRock, and the other is Vanguard's Wellington, which is Wellington's a fairly famous old line value fund manager, and both of these are really exciting to me. And then I have two infrastructure pieces. So again, these aren't particularly areas that might do spectacular and higher inflation, but there is a big push towards infrastructure because of what's happening politically in terms of the American Jobs Plan. This is a traditional infrastructure. This is more of a technology side of infrastructure. Um, but here, materials, we have Vanguard's materials. So this Vanguard kind of buys all the different material companies. And then here, Invesco is taking just the material companies out of the S&P 500 and then weighting them equally. Most of the times you're weighting things based on the market capitalization, which is what happens here. So theoretically, materials are going up in price in an inflationary environment, which makes these companies that are making copper and lumber and those types of things make more money during that period of time. So that's a good inflation hedge. Then consumer discretionary. Again, this is just a play on the reopening as people start to spend more. I saw a presentation today, and they said that American savings rate's currently at 15%, which comes out to about $6 trillion a year of savings. If you compare that to where it was, even before the pandemic, it was about less than 1 trillion. So lots of money that can come out that I think will come into different types of places. Banking is a great hedge against inflation. They do better when interest rates go up. Transportation is going to move here because people are moving and things are moving at a faster rate. And then exponential technology actually is just my one overall technology piece here. And that's not so much an inflation play, but it is a play for when the growth side of the equation takes off, which is today actually. So these two pieces are more my growth, SIMS and XT here. And they actually are doing really well right now today, as we've had a great run in the NASDAQ today. So, you want to have different pieces in there, but we're definitely geared towards this value, really inflation play as far as that goes. And that's my outlook for the stock piece as far as that goes.
So before
Yeah,
you jump over from stock
yeah.
to bonds, could you explain the difference like between like an equal weight fund versus a market cap based fund?
Yeah, it's actually a pretty good question because if you look at say the S&P 500, it's market cap weighted, which just means that a company like Apple is going to have a lot more impact on that particular index than a smaller company would. Matter of fact, the top five companies in there, five or six, make up a lot of the movement of the S&P 500. So sometimes you want to get representation on some of those smaller or mid-sized companies. So if you use equal weight, that just says, all right, we're just going to say here's 60 companies, we're going to buy the same percentage of all of them. And it gives you a better exposure to some of those smaller or mid-sized companies that are in that particular index. I like both. And there's lots of different ways to weight these indexes. They can weight them on revenue, they can weight them on dividends. And so the weighting is something you really have to understand so you can see what's going on within those. And I have two equal weight pieces in here that I happen to like as far as that goes. But I like that mixture too. I like to have both, market cap weighted and equal weight in that same portfolio. So yeah, it's a good question. All right, so then the other piece is the bond side, which I'll show here real quickly because this is actually more difficult. This is our current traditional model with just the 100% bond. So bonds do very poorly in an inflationary environment because when inflation goes up, that drives the yields of bonds up, which means that the price of the bonds are going down. And the price generally goes down faster than the yield comes up. So you can lose money in the bond market in this particular environment. So there's a couple of ways to try to hedge that or strategize around that. Number one is to stay very short term with your bonds. And that just means that they don't move up and down in terms of the price as much as something that's longer term. And so here, for example, we got short-term government with Vanguard. Short-term tips, this has actually been doing very well. A tip is a Treasury inflation protection security. These are designed by the Treasury to do better in an inflationary environment. And basically what happens is the yield moves up with inflation. So, and it protects the price. And then high yield is an area that in an improving market, high yield does better. But if you go with a shorter term high yield, there's some questions about how this works, but you are insulated somewhat by a higher yield as far as that goes too, so that helps. And then I have two that are inverse. That means they go the opposite direction of the bond market. So when the bond market falls, these might go up. And so I have one that's a 7 to 10 year treasury inverse and another one that's a 20+ year treasury inverse. So for example, Monday, Tuesday, Wednesday, when the market was falling apart and bond yields were going up, these were actually, and bonds themselves were going down because the yields were going up. It's an inverse relationship, but these went up. And so that's why those are in there as far as that goes. And then you know, you can see the mix. So here's a 60% portfolio. So I got 40%, in the bond pieces and 60% in those 15, stock pieces. So that's, this is actually our most common portfolio is the 60/40 mixture. Um, so anyway, that's what I would be looking at in terms of trying to fight inflation. In my opinion, really trying to make sure that you have pieces in the portfolio that have, less sensitivity to rising interest rates. So your big tech stocks might do okay just because, for example, Apple reported a 54% increase in revenues in their lab, which is an unbelievable number for a big company. But your other tech stocks, your exponential, your tech stocks that are like what we see in the ARK funds, for example, innovative technology, clean energy, genomics, those all ran up so much when interest rates go up. They tend to really suffer. So you definitely want to rotate, in my opinion, somewhat out of those, maybe not completely, but somewhat out of those and towards these economically sensitive kind of value stocks, transportation, materials, financials, energy, those types of things are things historically that have done better in this particular type of market. So we'll see how that plays out.
So, follow-up question from
Yeah.
Lane about that is, how long do you see like this higher inflation continuing for?
Well, what happens, of course, is that you've got this shockingly fast delivery of a vaccine, really, historically, very, very fast. I read an article once that said the fastest vaccine development in history was 4.75 years. The average was 10 and a quarter. And we were actually giving people shots of this new vaccine within 9 months after, starting the development. So that's a modern day miracle, and then it's been rolled out fairly quickly. And so here in the US, especially, we're seeing a reopening come very quickly. And you've got companies that really couldn't keep up, and they shouldn't, right? I mean, why would you have millions of rental cars if you're a rental car company if nobody was going to use them? And then all of a sudden you need millions of rental cars, and now you're running around. The rental car companies are actually buying cars on the used car market because they're running out of cars. Um, and so what normally happens though is that there's just so much profit. So if you were renting a car for $60 and now you can get 500, all of a sudden you find new cars, you go out, and so once the supply starts to kind of match the demand, but the demand, in my opinion, is going to exponentially grow here. I think this summer is going to be really hot. But you have to take a look at the whole world, not just the US. When you really want to see a situation that gets super tight, you need to look at the whole world, because what we've seen is every time, we have this inflationary fear that comes in, the yields on the bonds come up, the market struggles in that environment, but then we see a lot of buying coming into those US bonds. So when the US Treasury 10 years at 1.7%, and the German equivalent of that is at, negative 0.12, and the Japanese equivalent to that is at zero point 0.1, people are going to buy US bonds. But eventually, as all of these countries start to experience more reopening, that will continue. So we're going to see kind of phases here in the US and then other countries as they start to roll through this vaccine. I wouldn't be surprised if this doesn't last a year. Some things will be different. Like we're already seeing some pullback in lumber prices. It went up 4 times, the value in total. And so, if you can get 4 times more money for lumber, you're going to desperately, and if you sell lumber, you're going to desperately try to find more. And eventually you will. And because, it's just so profitable. And then, of course, that supply starts to come online and starts to drop those prices down. And so we've seen lumber come down. I don't know where it ended up today yet, but it was down today when I looked earlier. 4 days in a row, the price of lumber has come back down some. So, and that's true of all of these things. When there's this huge price, all of a sudden companies find, some supply, and they really push hard because it's just massive profits potential. So yeah, I suspect that this will go on for a while. Um, Having said that, I think that there's a chance here that inflation fits sort of in this Goldilocks window where it's not too high and it's not too low, and we might be able to see a stock market that does okay, because inflation means higher profits and higher revenues. I mean, it's a growing economy. And the weirdest part about inflationary problems is that you can have an economy that's too good, which makes the market, struggle, mainly because they're worried that the Fed is going to come in earlier than expected and start to ease off on their bond purchases and start to raise their interest rates. So, yeah, it really kind of depends on the situation, but I suspect that 12 months wouldn't surprise me at all.